Welcome to our webinar this evening. I'm Holly Corcoran from Corcoran Business Advisory Services, and I'm with Justin Weaver from Weaver Law. And we're going to talk about business contracts and tax planning, tax strategies for veterinary practices. A couple of housekeeping items is to, if you have questions, please put them in the Q&A. And we will answer them at least at the very end. We'll provide at least 10 minutes of time to answer questions. We will be, as you can see, and also the slides will be sent out after this webinar so that you'll have that as a reference. And tonight, Justin is going to get started first. Turn that over to Justin.
All right. Thanks, Holly. All right. So tonight I'm going to take a crack at providing an overview of business contracts for veterinarians. This is a very, very broad topic, and one that, frankly, we could probably spend 5 days going through if we really wanted to get into all the nitty-gritty. I'm going to try to tackle this in about 20 minutes, so we're certainly going to stay at a very, very high level. But I think we can still get some pretty important information and things to look out for as you're working through business contracts, any type of contract, really, throughout your career as a veterinarian. This first slide here is really just trying to give an idea of all of the different types of contracts that you may encounter as a doctor throughout your career. This is indicative of how broad of a category we're talking about here this evening. We're not going to talk about all of these, but each one of these contracts that you might encounter has different implications on you, on your career, on your practice. Also has different things you have to be concerned about. And so just kind of keep in mind as we go through this, the variety of agreements that you may encounter and that we assist clients with on a regular basis. So before we jump into talking about a few specific types of contracts, I wanted to lay out just some general considerations to be aware of as you're considering a legal agreement. The first, and a lot of these are frankly misconceptions that I've found with clients, with folks that come to me with contracts and make certain statements that I have to correct and make sure, wait a minute, that's not necessarily the case. One of those is that there is such a thing as a standard contract. I've heard this dozens and dozens of times where somebody comes to me and gives me a contract and says, I don't want you to spend a lot of time looking at this. It's a standard. The broker told me it's a standard contract. It's a form document. Everybody signs it. It's got everything we need in there. I've been practicing for 14 years at this point. I've yet to come across a standard contract. There's no such thing. Every contract is different. Unfortunately, every word in a contract matters. And so you have to carefully analyze each contract and make sure you know that there is no such thing as a standard contract. Some of these interrelate in terms of these general considerations. The next one is to be careful where you get your advice. There are a lot of resources out there for you as a doctor and as you go through your career. A lot of free resources, a lot of good resources, frankly. There's a lot of webinars, there's social media groups, there are, your colleagues, your professors, a lot of folks who are going to be willing to opine to you as to what they think is or is not the case. Be very careful where you take that advice. It may be well-intentioned, but it also may be very wrong. And it may be very wrong for a number of factors, one of which is the next point here, which is that the enforceability of contracts really does vary from state to state, and sometimes widely. For instance, we're going to talk about non-competes and restrictive covenants here in a few minutes. Some states, those are not enforceable for employees. Other states, they're very much enforceable for employees, and employers are given broad discretion to enforce those. And so make sure whoever you're getting your advice from understands the locale that you're located in and is able to analyze that for you. And again, your colleague in a different state or even a different city may be correct in telling you that their non-compete is not enforceable, and that very well may not be the case for you. The next two points here, again, talking about advisors, obviously, as an attorney who represents a lot of, exclusively represents veterinarians, I'm going to tell you to rely on your advisors, rely on your attorney, rely on your accountant, let them tell you what the contract says. With that said, though, it's also on you to make sure you understand what the contract says and what the implications are on you. I can tell you that something in a contract is very standard. I can tell you that the non-compete that your employer is asking for makes sense and it's consistent with what other employers will ask for. But if you have a spouse who works across town and you intend at some point to go work with your spouse, you need to tell me that. And we need to make sure we build in appropriate carve outs and exceptions that meet your circumstances. And so you have to really take ownership and rely on your advisor, but it's also very important for you to make sure you understand and ask the questions that allow you to understand the agreements. A good advisor should be able to pull those things out of you, but it's important that you stay engaged in the process. The final point here is very important, and frankly, is a point that I always rail against, and that is to avoid dual representation. And what that means is to avoid a situation where somebody is both advising you and the other side of the contract, whether it's a buyer and a seller, an employer and an employee, a landlord and a tenant. That person may tell you, it may be a broker, it may be an attorney, they may tell you that doing that is going to allow you to save money, save expenses. They may also tell you it's going to create a situation that's less controversial or less combative, I should say. That is not necessarily the case. And more importantly, it's impossible for someone to represent, even if your interests are totally aligned, it's impossible for someone to represent a seller and a buyer and have both of those folks' best interests in mind. So make sure whoever you're getting your advice from is solely representing you. So moving forward and kind of digging into a few specific examples of contracts, the first one I want to talk about is a letter of intent. And it goes by a lot of different names and may be referred to as a term sheet, a statement of understanding. The name doesn't actually matter. What this document does is it's generally the first thing that you're going to sign whenever you're entering into a transaction. It may be a sale of a hospital. It may be an employment arrangement. It may be a lease arrangement that you're entering into. It's going to set forth the material terms that both sides are agreeing to. And the idea is to make sure you're both on the same page before you start incurring a lot of legal expenses and taking all the actions that are necessary to kind of get the ball rolling and sign actual definitive agreements. The first takeaway with a letter of intent is that it should be non-binding. And so generally a letter of intent, both sides can back out of it if they want to do so. It sets forth the material terms, but then if you can't reach an agreement, you can walk. Frankly, even if you change your mind, you can walk. And that's fine. That's what we want with a letter of intent. The one point I would mention, though, is just because it's not binding does not mean it's not important. A lot of folks have a misconception that because it's not binding, you can just go back and renegotiate the letter of intent at a later point. Legally speaking, sure, you're not bound by the agreement. You could go back, and I certainly have had clients who have found out something and have gone back and renegotiated purchase prices, employment terms, lease rates, whatever it may be. However, once you sign the letter of intent, the other side is expecting that you're going to live up to the terms that you've agreed upon. And if you go back and start renegotiating, they may just tell you to get lost. Even if they're willing to entertain the discussion, you're going to burn through a lot of goodwill and a lot of your leverage with the other side and with that relationship. And so letter of intent, non-binding, but make sure you are agreeable to whatever is in there. The one caveat with this discussion about being non-binding, and this really applies mostly to sales and acquisitions of hospitals, is that oftentimes there is an exclusivity provision within that letter of intent. And this usually is binding. And what this says is, as the seller or certain other relationships, you're agreeing once you sign this letter of intent for some period of time you're not going to enter into discussions with other potential parties. So you're not going to keep negotiating with other potential buyers. That one usually is binding for anywhere, 90, 120 days, somewhere in that range. And again, this goes back to the fact that the LOI is important, because once you sign the LOI, you've now lost all of your leverage with the buyer to negotiate, to pit offers against one another, because now you're stuck with that one offer for the next 3, 4, or 5 months before you can talk to anybody else. So moving along, and this is, I said I was going to oversimplify things. This is going to be an extreme oversimplification of things in connection with hospital acquisitions and sales. But I do want to just kind of point out a few considerations, and we really look at this from both the buyer side and then on the opposite side from the seller. Again, going back to the fact that the interests really do differ here, which is why I railed against dual representation at the beginning of this presentation. On the seller side, the most important thing is going to be pretty obvious. You want to make sure you get the full payment that you're expecting as part of the deal. If you're getting paid fully in cash, that's easy. We just make sure the agreement provides you're getting paid at the time of closing. Oftentimes, especially when we start dealing with offers for hospitals from corporate consolidators, more sophisticated buyers, you may not get all of your money up front. And so there may be a promissory note where you're paid over time after the closing. There may be certain earnouts where you have to agree to work for a period of time after closing in order to get paid, or hit certain revenue thresholds in order to get paid. You need to make sure you completely understand those things, and also that you eliminate any trap doors, as I refer to them, within those provisions. And so, for instance, if you have a agreement that says you have to work for 1 year in order to get paid another $100,000, well, what happens if you get sick and you can't work? We have to address that situation and make sure that the buyer may still say that's a risk you have to take, but we would generally try to negotiate that and make it a more friendly term. So make sure you're going to get paid. Make sure the consideration you're expecting you're actually going to receive. The other big thing that you're going to have to make sure you're okay with as a seller is the non-competes and the restrictive covenants that you're going to sign. Any buyer, certainly any sophisticated buyer, is going to require that you sign a non-compete in order to sell your hospital. I'm going to skip over this one because we're going to talk about this in more detail in a minute, but that's going to be a critical consideration for the seller. And in fact, on the buyer side, that's also going to be a critical consideration. From the buyer, the main thing you're trying to do with a purchase agreement is ensure that the goodwill that you're purchasing in connection with the hospital is actually transitioned to you. If you leave the door open where a seller can sell you their hospital, but then go out and compete with you in some way or solicit away clients, you're not getting what you've paid for. And so it's critically important to make sure you have ironclad restrictive covenants in connection with a purchase agreement on the buy side. On both sides, you're also going to have to consider the representations and warranties that are set forth in the agreement. There's going to be several pages of these generally where a seller is making certain points, certain representations about the practice. They're going to tell you, this is what we pay all of our staff. All of the financials we've given you are true and correct. The seller needs to make sure all of those things are correct, because if they're not, they could have liability. On the buyer side, they want to make sure that all of those things are expansive enough to ensure that they're getting the practice that they're getting is what they're expecting to get. And if there is a problem, that they're not inheriting that problem moving forward. The other thing that comes up in connection with a sale and acquisition generally is what the seller's commitment is going to be after the sale. So usually there is some period of time where a buyer is going to expect the seller to keep working at the practice. Sometimes if it's a doctor-to-doctor transaction, sometimes that's going to be a very short period of time, and the buyer is really just looking for someone to be there and help transition the practice. If it's a corporate deal or another buyer who's not coming into practice, they may expect that you work there for 2 to 3 years. And so understanding that commitment which hopefully is going to be laid out in the letter of intent at the beginning of the process, is going to be critical for both sides. As promised, I did want to spend just a minute on restrictive covenants. These are a hot topic in almost everybody I talk to, from employees who absolutely hate the fact that they're being asked to sign a non-compete, to employers and practice owners who are trying to find a way to protect their interest in the practice. There are a few different types of restrictive covenants. The most common, or the most known, I should say, is a non-compete. That's a provision that's going to say you can't go out and practice veterinary medicine within a certain radius of a hospital. Maybe it's 10 miles for the next 2 years. That's the one that everybody kind of knows about and thinks about the most. There are also non-solicitation provisions, which are going to prevent you from soliciting and treating, in some cases, clients, from soliciting and hiring employees of the practice. The idea is, even if you go outside of that 10-mile area that I talked about, you still can't start taking my clients and taking my employees and kind of poaching those folks from the practice. Again, enforceability here of non-competes varies widely. You have to be very careful. Never assume that a non-compete is not enforceable. Clients tell me that all the time. Somebody told them non-competes are not actually enforceable, so what do they care? It can cause all kinds of issues from, first of all, in order to find out it's not enforceable, oftentimes you have to go through a lengthy court process, which is going to be incredibly expensive and take a lot of time. More importantly, or I guess more practically, I should say, if you have a non-compete, even if it's not enforceable, you may not be able to get a bank loan whenever you go to buy a practice. The bank's going to look and see the non-compete, and they're not going to be comfortable lending you the money. The other takeaway with restrictive covenants is that the wording really, really matters here. Again, no standard contracts, there's no standard restrictive covenants. And so an agreement says you can't solicit clients from your former practice. What does that mean? Does that mean if you run into somebody at the grocery store, you can't tell them, hey, I'm now working across town? I don't know. I mean, maybe. It depends on what the contract says. Does that mean you can't be listed on a website for another practice that you're going to go work at? Maybe. And so we always try to clarify those things when we're negotiating these contracts. Really have to make sure the wording is clear as to what you can and cannot do. Okay, employment agreements. Going to rush through this a little bit as we're getting tight on time here. This is the one that most doctors are going to encounter: an employment agreement, an independent contractor agreement. It's probably the first contract a lot of folks are going to run into. These contracts can have significant impacts on your career. And so it's obviously important to make sure you understand the compensation terms, the benefit terms, make sure all of that is outlined clearly, make sure you understand it. But then you need to make sure you understand everything else that's in there and how it could impact your career after you've spent years and a lot of money getting to a point in your career where you get licensed and now go out and work. Restrictive covenants that are going to limit where you can work after you leave. Other provisions where you may be getting a very large signing bonus, but if you leave, you actually have to pay that back. And so that's going to be hanging over your head and may prevent you from leaving. Termination notices that you're required to give. Again, employment agreements vary widely. Making sure you understand how it's going to impact you. And I can't emphasize enough, make sure, I realize you don't want to spend a few $100 after you come out of vet school to have an attorney review your contract. The amount of cost and damage that you could do yourself by not having somebody review it is exponentially more. So make sure you review it with somebody who understands what they're looking at. The other thing that is also often overlooked is the real estate. Real estate is critical in connection with any hospital. And so your lease is going to be incredibly important. If you're going to purchase the real estate, incredibly important. Without the location, you don't really have a hospital, right? In most cases, obviously, there are mobile businesses. There are other business models that don't necessarily have a brick and mortar location. If you do, in kind of a traditional hospital, you need to make sure you have the ability to continue to occupy that space long term. A lot of times folks will say, well, I can just relocate and find a new space if I need to. That is not an easy process. That is not a quick process. And most importantly, that is not a cheap process. And so buying a practice and then expecting you may need to relocate within a short period of time is not at all a good idea. You need to make sure you have a long-term lease in place. If you are considering owning versus leasing, there are there's kind of what I have found to be a very common belief that owning is always better than leasing in this space, which is not the case in a lot of other businesses. That's not always the case. There are downsides of owning the real estate. You now are responsible for a lot of things you may not be responsible for as a tenant. It still may make a lot of sense, and you have to analyze the situation in each case, but don't always assume that owning is always better. My final point here, I'm going to skip over this largely, but just make sure if you are going to be a landlord after you sell your hospital, there are a lot of things that you need to make sure that you're addressing in connection with that. Whenever you are selling the hospital, make sure that you've clearly outlined the terms of the lease that you're going to be entering into and going to be having as a landlord. Again, going to skip over this, but this is indicative of the number of issues that are out there for you as a tenant as a lease. You need to be very, very careful with your real estate. Do not just assume that you're signing a basic lease. This stuff is very, very important to your practice. And then finally, and I'm going to hand this over to Holly here, the last piece that I want to talk about is practice buy-ins, partnerships. The kind of threshold issue here is how do you value that interest in a practice whenever you're becoming a partner. Somebody like Holly is going to be the person you talk to there, not me. But you need to make sure you understand, you're now inheriting the debts, the liabilities of this practice. You're inheriting things like if they have taken certain actions to get tax benefits by paying their kids or increasing the amount of the lease they're paying to themselves as the landlord. Working through all those things is really important. And then the main thing with buy-ins is that this is the most difficult transaction to document for me as an attorney. We spend a lot of time trying to address absolutely everything that could go wrong, and we do address a lot of things, and we make it better on the back end if we address all those things. But anticipating a breakup from the beginning is tough. You have to do so. You have to deal with who buys one another out. How do you do that? What's the process? More importantly, though, and again, this isn't really a legal takeaway as much as a general business takeaway, is that no matter what the contract says, you're stuck with this person, right? We can give you abilities, buy-sell agreements and abilities to buy one another out. And sometimes you can unilaterally trigger those, but you're operating a business with this person. They may not breach the partnership agreement, but they may just be a terrible partner. And so you try to address certain things, expectations, do all of that up front. But if you're going to go into a partnership, you have to understand that risk with the personal element. And you really need to do what you can to make sure that this is a person that you want to partner with. It's impossible to do it without any risk. I've had best friends who have partnered together, best friends since kindergarten. They end up in a dispute after they become business partners. That can happen. But be very careful to analyze who you're going into a partnership with. And then when you decide to, make sure you outline all of the expectations and try as much as you can to address everything that could go wrong in that partnership. Okay, so I think that is it for me. I'm going to go ahead and hand this back to Holly.
All right. Oh, thank you so much. That was fantastic. I appreciate it. And we'll address questions at the end. So let me bring up my slide. Okay, so hold on. I didn't share my screen. Okay. Are we set?
Yep.
Okay, great. All right. Well, thank you very much for the presentation on business contracts. They can be confusing and definitely you need professional help. As Justin was talking about, for dual representation, it's good to have an attorney and an accountant on both sides because we want to definitely weigh and measure the aspects that are going to be beneficial for the seller versus the buyer, or whatever side of the contract it is, because everybody has different objectives and intents. So I'm going to be talking about tax tips for veterinary practices. I do want to talk a little bit about the contract accounting and tax considerations, very brief overview of some of the items that Justin talked about, and then I'm going to go into the new tax bill, HR 1, that was passed July 4th of 25, and then some other strategies that have not changed, but definitely you want to keep in mind now before the end of the year. So on the asset and stock purchases, you're going to be looking at, this is where the two sides come in. The seller has capital gains or ordinary income, and the buyer, what they're buying, subject to depreciation or amortization. So the objectives of how that purchase and sales price is allocated is treated differently or felt differently by both parties, but they have to come to an agreement, and then there's a form that gets filed with the IRS that says we have this agreement as to how the sale allocation is done. Employment versus independent contractor, there are behavioral considerations that are on the IRS. So you have to walk and talk like an independent contractor if you're going to be receiving a 1099, which means basically you hold yourself out to other parties for this type of work that you're doing. And for veterinarians, like a relief vet, they're going to go from one practice to another. They're definitely a 1099 contractor. Whereas an employee that comes into the hospital or is in the practice, or part-time or full-time, but you're exercising control and other behavioral factors that's subject to wage, and there are payroll costs associated with that W-2 income. The operating and partnership agreements, this is absolutely imperative because it really defines how we set up that entity. Go actually to file the first tax return, we want to make sure we're filing the correct form, that we're allocating profit and loss sharing appropriately, and a lot of the other factors that are in there. And as Justin said, you want to make sure that you consider the breakup ahead of time, because it's better to make those decisions while you get along than when you're not getting along. If you have a practice buy-in, yes, valuation of the interest is going to be very important. Are you going to take some sort of book value? Are you looking at some sort of market value? And it's also going to have to do with how the profit and loss sharing is. And this buy-in allocation for the veterinarian coming into the practice becomes their basis. That's what they have expended, or that they're contributing, or what they're buying in, and it affects how their taxes are treated down the line. Leases, even if it's commonly owned, even if you own the building and you own the practice, hopefully they're in two different types of entities. You do still want to have a lease, because if the IRS comes in, they're going to want to see that lease as a part of the audit. And I think we had another webinar, we talked about triple net, which means that the operating entity, which is the veterinary practice, pays a lot of the operating costs associated with the real estate, pays rent to the lessor, and which may be you as well. And that covers mortgage interest and depreciation and so forth on that side. But it's a way also of allocating income out of the operating practice, which is usually subject to potentially self-employment taxes. And therefore you get some sort of passive income that's going to the lease. It has to be a fair lease, and it has to be in the contract. Real estate sales and acquisitions. Again, that's what I was talking about, the passive income, how we treat that lease. But if you sell it, you have capital gains. And when you go to purchase that real estate, you really might want to think up front whether you should have something that's called a cost segregation study. And that allows for faster depreciation over time. So you get better tax breaks earlier, depending upon how they break that building down at the time of the purchase. And sometimes even better if you're actually constructing to have that study done with the actual construction of the building. Vendor and lab contracts. This is how we recognize the expenses, but also sometimes in there's rewards or points that are earned that can be allocated to either future equipment purchases or reductions on pharmacy costs and things like that. So we just want to make sure that we're tracking those reward points as a part of that. Buy-sell agreements, sometimes they're funded by insurance. Who owns the policy, who pays the premiums, and who's the beneficiary. For instance, if the company is going to be one buying the stock back or buying interest back, then they will hold the policy, they'll pay the premiums, and they'll be receiving the insurance proceeds. Insurance policy premiums are non-deductible, and the insurance premiums that come back in are non-taxable. Broker agreements, in your sale, like who is, what is the cost of that, and who is, who's responsible for, different aspects of the agreement between, what is the broker doing for you, what is the attorney doing for you, and so forth, and the overall costs associated with that. And that's also dovetails with the letter of intent. I like to make sure that we address the tax considerations before that's signed. But as Justin said, it is non-binding. So if for some reason it has been signed and you do have the ability to be able to make changes, hopefully minor, then we want to definitely look to make sure that the cash flow is going to work for you if you're looking to retire or invest in something else, and what the taxes are going to cost you in that process. And then financing agreements, we want to make sure that you're receiving a fair interest percentage and that the terms are agreeable, that it's not too costly in exchange for what you're actually buying. And the other thing too, I like to tell people is, because a lot of times the owners are guaranteeing any type of debt that they get into, even though it's corporate debt, you have to really watch your personal credit, because that can have an impact upon whether you're able to get into a financing agreement, even on the business side. The next, I want to talk about the new tax bill that came in, along with some other, tax saving strategies that did not necessarily change. Deductions and credits that are now still available that we're supposed to sunset at the end of 2025. Some specific strategies for vet practices and some action steps that owners can take. So I know that most everyone other than CPAs, their eyes glaze over and, the ears start humming when you talk code sections. But this is one that we definitely identify as Section 179 depreciation that allows 100% deduction. You up to a certain amount of purchases, but I'm not going to get into those dollar limitations. And then new what changed this year was bonus depreciation with the Tax Jobs Act in 2017. Bonus came into play, it was 100%, and then it went down 20% every year. It's now back up to 100%. So that's another planning opportunity where it used to be buying equipment. It was a systematic allocation over time versus the ability to be able to deduct it up front. And an asset that we're talking about is something that's a greater than a year in, that the life of the asset is greater than a year and that the cost is at least $2,500 or over. Because what I do is I attach a de minimis note to the tax return that says anything under $2,500 we're going to expense. So we want to look at the equipment and other purchases and to get the best tax advantage. So in other words, if you're buying during the year and obviously it makes a good business decision and so forth, I would like to be part of that planning process throughout the year to say, what is going to be the impact at the end, and so that we know that up front. Or you may get to the end of the year and find that you need to replace a certain piece of equipment. And does it make sense to do it in the current tax year or the next tax year? We definitely want to take a look at that to see where it's going to serve you best. Because for instance, if your business is skyrocketing and you're going to be at higher tax rates next year, it might make sense to push it off to the new year. The qualified business income deduction. This is something that you as professionals do not necessarily need to track. I'm just making you aware of it, that there's a 20% deduction on pass-through business income. And what that means is if your business is structured for tax purposes as an S corporation or as a partnership, it spins off what's called a K-1 form that shows you the net income by classification that's going to go onto your tax return. And what happens is if the business income comes through, usually that's available for 20% deduction. But because veterinary practices are considered SSTBs, which are specific service, trade, or business entities, there are income limitations that are on the individual level. So that's what I like to do is say, when we're doing our planning throughout the year, let's look at what the impact is on the overall tax return, because that's going to tell us whether we're going to be able to take that 20% deduction. And we may want to marry that with, should we take more depreciation? Should we, definitely get that equipment at the end of the year, because now we still will be able to take advantage of this deduction. So it's definitely a big part of the planning process. The overtime deduction, and I know most everyone has heard through the news that overtime is now going to be a deduction for employees. And obviously this is on the individual level. But I wanted to bring this to your attention because there's going to be tracking that's required on the employer side. And what happens is you have to now go back to the beginning of the year, determine what the overtime that was paid for the employees. And a lot of times it's a separate line item anyhow. But if not, you want to make sure that you have those records, or you talk to your payroll provider, or if you do it internally, that information is readily available. And then what happens is it's not all the overtime. It is that increment that relates solely to the overtime benefit. So in other words, your normal regular time is 1 times your hourly rate. Time and a half is usually 1.5 times, or the 50% is the advantage of having overtime, and it's that portion that becomes the deduction. So in other words, for example, if you have a $20 an hour employee and you have to pay them $30 an hour for overtime, that $10 an hour difference is the deductible portion, and that's going to go on the W-2. And of course, it's for certain types of employees that work greater than 40 hours a week, but usually that's your non-professional staff anyhow. Bonuses and incentive pay do not qualify. And as I said, this is something that's going to be now retroactive to the beginning of the year. So we're going to do our best effort. The IRS is saying, we haven't even gotten the IRS guidance yet on this new tax bill, and it's due within 90 days of signing. But what they're telling us is they're going to rely on the best efforts. And then in 2026, there's going to be specific guidelines. The meals deduction, business meals are still at 50%. There was when you had employee meals provided for the employer benefit. In other words, somebody that had to stay late at work and you provided their meal, that used to be 100% deductible, and that is no longer the case. It's 50%. Entertainment is no longer deductible. It hasn't been for the last year or two. Meals tied to entertainment, if they can be identified, you can carve it out and take the 50% deduction. And if you take your employees out to your Christmas party or some sort of a celebration that involves a meal, those are actually still 100% deductible. This is one I think is really important because education reimbursement is, we want to absolutely make sure that we have education opportunities available to our employees. But for the veterinary staff, the ability to pay student loans as a part of this reimbursement is very valuable. And this is a non-taxable benefit that's not included in the W-2, and it's supposed to be adjusted for inflation after this year, but it's $5,250. And it covers tuition, fees, books, supplies, and so forth, as well as the student loans. And the practice owners are entitled to this benefit as well, as long as all eligible employees are also able to take advantage of it. And this should be documented in the employee handbook. And I just kind of give you a heads up too, that if you're planning on providing this type of a benefit, think about the total number that this is going to potentially involve. Let's say you have 10 employees and you want to do the $5,250, because as an owner, you could definitely pay that against your student loans. You got to look at $52,000 as a potential expense if everybody has reimbursable education expenses or student loans. So keep that in mind. It doesn't have to go to the max. You could say $2,000 per employee, $3,000, whatever, but make sure that you're looking at what you ultimately can afford to pay out from the practice. Retirement plans did not change much. The simple IRA, as stated, is easy to set up. It's lower cost, but it has lower limits for it to be able to contribute. The 401k provides higher limits. There's profit sharing opportunities. And this is one of the things where you can actually do some planning after year end if it has a profit sharing component, because you can say, okay, somewhere between January and the filing of the return, which would be March 15th or September 15th, because it includes extensions. You can say, hey, do I want to contribute to the employee's retirement on a percentage across their payroll and gain that as a deduction on the return? And you have to weigh that with the benefits that you're already providing the employees, but how your plan is structured and how much is that going to go into your pocket so that ultimately you get to save more over time. Keep in mind the employer match is a business deduction. Employee contributions reduce the taxable income. So that helps your employees. It helps the owners. You start with your W-2. If you have $100,000 and $10,000 to your retirement, it means you're only taxed on the $90,000 on your tax return. So that saves money over time. And then also the contributions grow tax-free and are distributed taxable upon, after 59 and a half without penalties, or you can structure it with a Roth component that allows the contributions to grow tax-free, but you didn't receive any tax deduction as you were contributing. But definitely keep in mind a retirement plan to stock away money for yourselves and help your employees. Health insurance and pre-tax benefits. If you're paying your health insurance as a part of a group plan, that is deductible and it's a non-taxable benefit. You can have it structured so that you pay up to a certain dollar amount per employee, and if they have to pay anything extra, you can have that extra as a pre-cafeteria plan, a pre-tax cafeteria plan, which means that they get that deduction just like the retirement. It comes off the federal wages. 2% shareholders of an S corporation, the premiums have to be added back to the W-2. And if you do a direct reimbursement of the individual plans, like say your employees go out to the marketplace and they have their own policies and you're reimbursing them, that is taxable and that has to go into their W-2. So vehicles, I know a lot of people say, oh, I own a business and I have 100% tax write-off because I have a vehicle that I use, but I use it 90% for personal purposes. That's not entirely correct. You actually have to use it for business purposes, and you can have a personal vehicle or an employee that is doing some, running around for you that you can do, reimbursement for mileage. This year it's 70 cents a mile, and make sure it's just documented in the employee handbook. Ambulatory or equine practices, 100% business use, even if they have to take it home for on-call services and so forth. And these type of vehicles are subject to that accelerated depreciation that we talked about earlier. So we've done everything we can, and these are just a couple of the topics, some of which changed, some of which did not change. But we try to reduce the taxable income to the best that we can. And then we say, hey, how do we make sure we pay in so that you don't have any surprises at the end of the year? We have federal and state quarterly estimated tax payments, or you can use the W-2 that you're receiving if it's an S corporation to pay those withholdings in advance and reduce penalties. And then, when you actually have tax due in April, you know about it and you're ready for it versus it being a surprise. Stay informed. Make sure that your CPA or tax advisor is talking to you about things that are happening during the year and how things are changing and how that's ultimately going to affect your business and your personal return. And make sure that you're planning throughout the year so that savings are not overlooked. Review some action steps, or review your asset purchases. Look at your retirement. Think about education and student loan reimbursement. And your vehicle use policies, make sure that CPE, employee, the reimbursement are all in your employee manual. And talk about your real estate and how you're going to be structuring that with a lease, or whether you're going to own, or how that's going to work for you. And finally, I want to say thank you for coming to this webinar. I greatly appreciate it. You can look for us at the AAEP conference in Denver in December. We're booth number 2653. And also the book I've authored is The Vet Advisor. Are you running your business or is it running you? I do have a white paper that is available for download that is an abridged version. That's on the website. If you need to get a hold of me, here's my email, and or give me a call for a quick conversation as to whether we can work together. If we can, then we'll set up a longer meeting where we can really dive deep into your practice. And that is pretty much it. Now let me go back and check to see about the Q&A and see if we have any questions. Let's see here. Wow, it looks like we did a great job because questions.
Perfect.
One question I do have for you is the letter of intent. Have you ever been in a situation where the final agreement that came back was so drastically different from the letter of intent that, it wasn't recognizable?
Yeah, I mean, generally it's not that it's not recognizable, but certainly, uh, I was just looking at one today actually, where the letter of intent outlines, we painstakingly outlined the terms of the lease down to who would be responsible for the HVAC and maintaining the HVAC. We got the agreement. They went back on a lot of those terms, and we're now working through the process of saying, well, why'd you agree to these? And they're saying we didn't scrutinize these at that time. So yeah, it does happen. I'd much rather be on my side where the LOI says what we want, because it is, again, we're going to enforce that. And in that particular deal, if they don't agree to that, I don't know if we're going to go forward. But yeah, it does happen. But if you outline those terms in the LOI, it's pretty rare. I mean,
Yeah.
once you lay out what the deal is, that's what the attorney is going to look at whenever they're preparing the document. So it's rare, but it does happen for sure.
Do you think it's a good idea to make sure we look at the tax considerations before the LOI is signed? Well, we can look at that again after, as you said.
Yeah, it's always a delicate balance because at that time, a lot of times you're dealing exclusively with business folks on both sides of the deal. And so a lot of times, even where I'm involved with an LOI, there may not be an attorney or an accountant involved in the other side. And so, in terms of like even basic tax things like raising what the allocation of the purchase price is going to be, that becomes difficult. And a lot of times we punt on that until the actual agreements.
Yeah, yeah. And I mean, like the corporate agreements and so forth, like you said, may have a year, a time holding where you start getting the final payment. So that might be then an installment sale. So that's an advantage for tax purposes, but then you want to make sure you're getting paid down the line.
Exactly. Yeah. Those types of things certainly should be in the LOI. And the type of agreement, I've seen LOIs that don't say if it's a stock agreement or an asset agreement.
Wow.
Obviously that's that's critical. You have to outline that piece.
Yeah, absolutely. Yeah, because we don't want to buy liabilities that we're not aware of. That's for sure.
Exactly. Yeah.
Now let me check the Q&A. Oh, we do have one question. In reviewing employee contract agreements, what are your typical biggest red flags, especially things as an employer offering such a contract should consider before including a contract in a contract?
From the from the employer's perspective, I guess is the question. The the biggest thing that an associate is going to look for and be upset by is going to be a non-compete that's unreasonable, something that's totally too far expansive, or some type of provision. A lot of times in corporate agreements, we see provisions that include what are known as liquidated damages, which say if you leave and you don't give us 6 months notice, you owe us $1,000 for every day that you didn't give us notice. Like that type of thing certainly provides the employer protection, but most employees are going to be very turned off by that. So unless you have a real reason that you have to have something like that in there, those types of penalties are really not well received.
Overly restrictive, yeah. Okay, well, I think that wraps up, and I hope everybody learned something, and thank you very, very much for your time and your knowledge. I greatly appreciate it, Justin, and we will get the slides and the recording out to everyone after this meeting, probably in the next couple of days. Thanks
Sounds
so
great.
much, and have a great day.